Let's talk about the various types of life insurance out there. So, the simplest is called term life. Term life is temporary life insurance, non-permanent. So, you're literally paying for temporary protection for a set period of time. So, let's say for 10 years, if you pass, your beneficiary or the person who's going to receive the money will receive the money if you pass within that period of time. But if you don't, the beneficiary is not going to get a dollar. Now, in real life, you can actually kind of roll that policy into another policy, but that might be getting a little bit too deep for right now. So now, with term policies, all you're paying for is death benefit, and it's temporary. So there's no cash value, which is kind of like the bank account of the life insurance policy. You can't take loans from the policy. It's literally temporary protection. The analogy I always use is if you go and rent a car and they ask you if you want that extra insurance, and if God forbids you get into an accident, that's gonna initiate. But if there's no accident, then obviously the insurance company keeps the money. So that's not going to be a security. Pretty much you have, and usually the premiums are going to be the cheapest. This is going to be the cheapest version of life insurance. From a suitability standpoint, it's great for, let's say, young families that maybe they don't make that much money and they have kids and they want to make sure that God forbid something happens to the parents that the kids have some money. The benefit of life insurance money is it's non-taxable to the beneficiary, so it just comes in tax-free in cash, which is pretty awesome. The only caveat is if someone has a substantial estate, so when they die, that's the money that they have left is called an estate. And if it's about more than $14 million, then you can start getting hit with estate taxes, and then obviously the insurance would flow to the person's estate when they died, right? The person who bought the insurance on their own life, and then it would go tax-free to beneficiaries. So it's possible that it could be taxed by the estate, but the beneficiary is still going to get it tax-free, right? So, I mean, what they do to to lessen that load is they will create what's called an irrevocable life insurance trust, and thereby they separate the life insurance money from their estate. So then there's no taxable hit, and the beneficiary gets it tax-free, so they get the full amount. So that's term. Now, the next one would be, in no particular order, would be whole life policies. Whole life policies are generally the most expensive in terms of premiums. Everything's guaranteed. There's a fixed return. Everything's guaranteed. This is generally speaking. And, you have a cash value that you can borrow against. You could take out money, FIFO, also first in, first out, which is beneficial. People sometimes take advantage of taking loans from their life insurance policy and make the difference on what they could possibly earn. But obviously, it's kind of gambling a little bit. But yeah, so whole life, not a security, everything's fixed, most expensive, guaranteed cash value, guaranteed growth, guaranteed death benefit. Everything's guaranteed. You know exactly what you're signing up for. Universal life insurance. Universal life insurance is it has flexible premiums, which means you don't have to pay a set amount every month, right? Which can be very beneficial for folks who have inconsistent incomes, or maybe just, at certain times they don't really have money to put in a lot. Maybe around Christmas they're spending a lot on presents, so they don't have the money to put into their life, their policy. So can be beneficial, but obviously you can't abuse it either. You can't get like a massive minimum benefit, and then all of a sudden, let's say you all of a sudden just under contribute. You can't under contribute. Obviously, if you over contribute, it grows faster, but you can't under contribute. If it's just pure universal life, it's not a security. Even like indexed universal life, that's when it's pegged to an index, but you can't really lose money on it because the floor is generally going to be zero. That's not going to be a security, so you can just sell it with your life and health license. You don't need your, 6 and 63 or 7 and 66, nothing like that. That's universal. Then if you throw variable in that mix, now it becomes variable universal. It's the same concept, except now now there is potential for gains in the market and also losses. Also losses. You still have a minimum death benefit, but you're not going to have a minimum cash value. It can fluctuate substantially. Um, and yeah, so with variable, it is a security, so the money's going to be invested in the separate account. You pick various sub accounts that are generally registered as mutual funds or unit investment trusts, you pick those, and accordingly, it's going to grow. Then the last one would be variable life insurance. So the variable life insurance, it's basically like variable universal, except variable is yeah, has fixed premiums. So the premiums are set, they're not going to change. So, that's the big difference between variable and variable universal. Variable universal has flexible premiums. Variable life insurance has fixed premiums. But, in both cases, the cash value is not going to be guaranteed because it depends on how well you do with how well you do how well it does in the market. So if you made bad choices, obviously it's not going to grow as fast. If you made good choices, it's going to grow faster and you're going to have a bigger death benefit. So yeah, and just kind of going back to like IULs, indexed universal, that would be kind of like a midpoint between like regular universal, where let's say you just have a fixed rate. IULs, are going to be somewhere in between, but they're going to be capped, and there's going to be floors, and then just variable universal, where you can make as much as you want, but you can also lose as much as you want too. So hope that gives you a little bit of background on life insurance. Definitely listen for more. Thanks.